You always hear analysts talk about EBITDA, but what does it actually mean, and why do investors trust it so much, even though it can sometimes be misleading? Before we break down the EBITDA formula, we need to understand what it actually represents. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It measures a company's profits from its core business operations without the effects of how it finances itself, the tax environment it operates in, or non-cash accounting items. Investors use EBITDA to get a clear picture of how well a company's actual business performs without outside factors clouding the results. Now that you know what EBITDA means, let's look at how it's actually calculated. EBITDA equals net income plus interest plus taxes plus depreciation plus amortization. Let's break each part down. We're going to start with net income because it's the foundation EBITDA builds from. Net income is the bottom line, what's left after all expenses are taken out. EBITDA starts with net income, then adds back interest, taxes, depreciation, and amortization to remove their effects and isolate core operating profits. Next, we add back interest, because it has nothing to do with operating performance. Interest is the cost of borrowing money, loans, bonds, or other debt. Because this depends on the company's financing choices and not its operations, EBITDA adds interest back to focus on how well a business is performing without bringing their financial decisions in the picture. Depreciation is added back because it's an accounting adjustment, not real cash leaving the business. Depreciation spreads out the cost of a physical asset like buildings, vehicles, or machines over the years they're used. It's a non-cash expense, so EBITDA removes it to reflect operating profit without accounting rules affecting the number. And now we're on to amortization, which is very similar to depreciation but with just intangible assets. Assets like patents, trademarks, software, copyrights, these are all non-cash expenses and get taken out for the same reason depreciation does. So what's left after all of these items are taken out? What does that leave EBITDA with? Once interest, taxes, depreciation, and amortization are removed, EBITDA leaves only the parts of a company that come from pure business operations. So this would be revenue or sales, all the money a company earns from selling its products or services. Cost of goods sold, or COGS, the direct cost of making the product, material, labor, and production costs. And finally, operating expenses, the everyday costs of running a business such as salaries, marketing, rent, utilities, and softwares. So now that you know what EBITDA shows, let's talk about why investors actually use it. Comparing core business performance between companies. EBITDA lets investors compare different companies on an equal playing field by removing interest, taxes, and non-cash items. This shows how each company's actual business operates and performs, without being influenced by different debt levels, tax rates, or accounting rules. Helpful for asset-heavy companies. This especially matters in industries with huge depreciation. Industries like manufacturing, telecom, airlines, and data centers have large depreciation expenses. EBITDA removes these non-cash charges so investors can see the underlying performance of this business. EBITDA removes these non-cash charges so investors can see the underlying performance of the business more clearly. EBITDA is also a common tool when investors are deciding what a company is worth. Investors often use multiples like EV Ebitda to quickly judge whether a company is expensive or cheap based on the money it generates from operations. And because Ebitda removes non-cash items, it can hint at how much cash the business generates. Because depreciation and amortization are non-cash expenses, Ebitda gives a closer view on how much cash the company's operations might actually be producing, checking if a company can handle its debt. Finally, lenders use Ebitda to see if a company can afford its interest payments. Lenders compare Ebitda to interest payments to see whether a company is generating enough operational profit to meet its debt obligations. There's a catch though. Ebitda isn't perfect. In fact, it can be misleading if you're not careful. Even though Ebitda is a helpful tool, it is also a double-edged sword. Here's what I mean. Ignores big cash costs. Ebitda leaves out things like buying new equipment and paying down debts. A company can show strong Ebitda but still have very little cash left over. It hides debt problems. Because Ebitda adds interest back, it doesn't show how much a company actually owes or how expensive the debt is. Two companies can have the same Ebitda but totally different risk level. It can be inflated. Some companies report adjusted Ebitda, where they remove even more expenses, sometimes things that happen every year, like stock-based pay. This can make the numbers look better than reality. And lastly, it's not a standardized metric. Ebitda isn't a part of the GAAP or IFRS, meaning companies can calculate it differently. So comparing one company's Ebitda to another can be misleading unless you know exactly how each one does the math. So how do you actually use Ebitda the right way? To avoid these pitfalls of relying solely on Ebitda, smart investors always use it alongside key metrics like free cash flow, operating cash flow, net income, debt ratios, and quality of earning checks. By reviewing these together, you can get a more accurate, balanced view of a company's true financial health, cash generation abilities, and risk profile, rather than just a snapshot of operational performance. So in short, Ebitda is a powerful tool, but only when you know how to use it. It's great for understanding the core business, but don't let it fool you. Combine it with cash flow, net income, and debt metrics to get the full picture. And yeah, guys, so that is the video. First video like this. So if you got anything you think I left out, or any questions, or just anything, type it down in the comments. I'd love to have a conversation with somebody down there. So just hit my line.